Answers. That's what this is about. If momentum trading actually works, then there must be verifiable entry and exit rules, there must be a technical indicator safety valve that learns to avoid the trade when the market changes direction, and the results must be empirical and explicit. And that's it. If non-directional option trading works, then again, there must be verifiable entry and exit rules, there must be a technical safety valve which learns to avoid a stagnating market, and the results must be empirical and explicit. The same goes for technical stock trading. There must be verifiable entry and exit rules, and the results must be empirical and explicit. And that's it. Answers. That's what we're about to see, and we're going to do it right now. We'll start with momentum trading. By now, the rest of the world has picked up on our published research that there has been, in the last 10 years during the bull market, pre-earnings optimism, in particular in technology companies. We're talking about this period right before earnings. We're not talking about what happens after earnings. That has turned out to be a bit of a coin flip. But there has tended to be pre-earnings optimism a week or 14 days before earnings, where owning calls and then selling them before the earnings event has been a fantastically good trade. Let's just take a look at how good it has been. We'll look over the last 10 years. We'll look at Microsoft, Google, and Amazon. We'll look at buying a call. We will do it with custom earnings timing. That is, we will open the position 7 days before earnings, and we'll close it the day of earnings. Since all three of these companies report after the market closes, this trade does not take an earnings bet. If these stocks reported before the market closed, then we would have to put a 1 here. And here are these fantastic results. We can see across the board from Microsoft, Google, and Amazon, just staggering results. 340% to 497%. The win rates are all above 60%. But there's a fair criticism which says, sure, if we could guarantee that we would be in a bull market tomorrow, then we could put this trade on today. But we cannot guarantee if we're in a bull or bear market. And the end of 2018 has been a perfect example of how quickly things can turn. So let's take this exact same test and let's just look at what happened over the last 6 months. And what do you know? All three of these have now turned into losers. Google and Amazon in particular have been monstrous losers on just 2 trades. So does that mean this pre-earnings optimism that we talked about before, does that optimism no longer occur? Or if it does, how do we know when it's going to occur? We're going to apply a technical trigger. And while in technical analysis, you will find thousands of filters, we take a step back at Capital Market Laboratories and looked at the single most used technical trigger, and that is the moving average. We will go down to a technical open rather than normal time. And all we're going to do is enter this trade 7 days before earnings if and only if the stock price is above the 50-day moving average. That's it. You can see all of the other settings we have here. We're not going to get twisted up in trying to combine 19 different measures to figure out a perfect technical strategy. We are going to do this same trade, but only if the stock price is above the 50-day moving average. For those of us that are more visually inclined, this is exactly what we're doing. We're waiting for the 7 days before earnings. That's this green E icon. We're checking to see if the stock price is above the black line. The black line is the 50-day moving average. Since it is, that triggers an entry, and that is the momentum we seek. We fast forward 1 earnings session, and again, we look at 7 days before earnings, but now the stock price is below the 50-day moving average. It's below that black line, and so no trade is taken. That is our safety valve. And here are the results now. Even over the last 6 months, you'll notice that one of the earnings was skipped. You'll see each of these stocks only have 1 trade, even though there have been 2 earnings in the last 6 months. And which trade was skipped? We can just click on a backtest tile. We can see the only trade placed, for example, in Microsoft, was in summer. Same thing with Amazon, the one that was in summer. And you'll find the same thing with Google. We applied a simple rule, and now we can compare these last 6 months using the technical indicator without the technical indicator. And here they are side by side. We know there are a lot of numbers. Look at the difference that just eliminating 1 trade has had. But now, let's look at the impact of this little filter over the last 10 years. That is, what if we used this technical open right here, that is, trade the 1 week before earnings, if and only if the stock is above the 50-day moving average, but let's do it for the last 10 years. And here are those results. And since we're dealing with a lot of numbers here we include the results without the technical trigger. To make things easier to read, we'll just show the total return of the back tests and the win rates. First we found the pattern, and then we found the safety valve. Using the simplest of technical opens, we have seen higher returns using just one of the phenomena that we have identified that exist in the market during both a bull and bear market. Of course, there's no reason to only look at 1 week before earnings. We can also try looking at short-term momentum trades, that is just 3 days before earnings, and looking for that pre-earnings momentum. And in this case, we'll look at Tesla and Nvidia. And here are the results over the last year for those two stocks. You see both of them have 4 wins and no losses, totaling over 500% or 200% on just 4 trades each. It turns out that we can also look at the 14 days before earnings for this pre-earnings momentum. So we have 3 days, 7 days, and even 14 days. And how do we find all these ideas? How do we know which stocks are working the best? That goes to the Pro Scanner. We'll click on Pro Scan, we'll select by strategy, we will choose a ticker group of the NASDAQ 100, and you can see there are so many scans that we have for idea generation. But in this case, we're focused on the pre-earnings scans, and we're looking at pre-earnings optimism. So we have the 7 days, 14 days, and 3 days pre-earnings optimism calls. We can even tap on the 3 days and look at those results. You can sort by the number of wins, by the win rate, by the average trade return. You can even sort by the length of the back test. But if we scroll down, we can see even more. Not only do we have the 3-day, 7-day, and 14-day pre-earnings long call, we also have the 3-day, 7-day, and 14-day pre-earnings long call with the technical requirement imposed on it. That is, those trades are back-tested and scanned if and only if the stock price is above the 50-day moving average. So you can see, even for this single type of trade, we have 6 different scans to find the best of breed. While we're here, you notice that we also have pre-earnings volatility plays, that is 4 days, 14 days, and 7 days before earnings, looking to own a straddle just to capture that rise in volatility and then closing it the day before. You can always just tap on a ticker in the scanner and it will bring up the backtest tile and show you those results in the backtest tab, where you can customize it further. And finally, no backtest is complete without setting the alert. So I go to the alerts tab. I want to do Nvidia and Tesla. I enter them common to limited. This is a days before earnings alert, 3 days before earnings. I'll put in my email address and my phone number, and I'll add the alert. And there it is. I will get alerted 3 days before earnings for Nvidia and for Tesla automatically via text message and email. So we have found the answers that we sought for momentum trading. We found a verifiable entry and exit rule. It was absolutely structured and methodical. We found the technical indicator safety valve that learned to avoid the trade if a bear market or a correction was starting. And finally, the results were empirical and explicit through a bull market and a bear market.